I'll come back now to patent box, because this is an aspect which is particularly worth mentioning in terms of longer term strategy and overall benefits. So the UK patent box regime provides for a reduced rate of corporation tax on profits derived from a patented invention, and effectively gives a 10% corporation tax rate for specific qualifying heads of income, provided you have good substance in the country where the corporation tax is paid and the invention has been developed by the company claiming from the patent box. Now, you can only claim those benefits once a patent has granted, but you can backdate for up to 6 years. So that was very much a whistle-stop tour of UK IP rights. But thank you all for your attention. And Roy, I'll hand back to you at this point.
Okay, thank you. Thanks very much, Catherine. I'm going to just very, very briefly touch on R&D, because I think most small firms don't realize the value of R&D credits that are available in the UK and the US and elsewhere as well. Basically, research and development grants are given for activities that directly contribute to seeking to achieve an advance in science or technology through the resolution of scientific or technological uncertainty. And there are indirect activities which are available as well, but they cover the cost that you can claim, cover staffing costs, externally provided services, software, relevant payments for clinical trials, for example, or consumable materials, subcontracted R&D as well qualifies. So all of these things, and there are many, many more, can come within the framework of research and development costs which can be claimed. The UK has a very advanced system of R&D credits, and it offers two alternatives. One is 130% credit over and above 100% of your costs. So in actually fact, it gets to 230% tax relief. Our tax relief, 230% at tax relief at 19%, which is our corporate tax rate, is a very significant sum. And that you can carry forward, but also you can surrender it to other group companies as well. So it's a very material tax loss that you can claim. And if you don't want to claim a tax loss because you think that you're not going to be able to recoup that over a period of time, you can actually get a tax credit. And the tax credit is calculation is 14.5% of the surrenderable loss. So 14.5% of 230% is actually 33.35%. So it's quite a significant tax credit. You get a third basically back of your expenditure from the government for doing your R&D claim. And most people don't seem to think about R&D claims that they can make. I really recommend chatting to your accountants about the R&D. Once you've identified what the intellectual property is, as Catherine has said, and whether it qualifies, which most R&D would, then it's worthwhile going to your accountants asking for that.
If one of the goals of your company is to be sold, be acquired by somebody else, if you do not own the rights to the patent, you are worthless, and that could be potentially a problem, even if you may have the right to use the invention as a license. That would be better than having nothing, but not as good as owning the patent. And so that at a high level is the third thing that you ought to be thinking about. One, what are all our rights? Two, what might we want to do to maximize our tax benefits? And three, are we about to shoot ourselves in the foot in terms of damaging our intellectual property rights?
Just on a question of what Mark was saying, the transfer of rights to a foreign subsidiary, for example, often with patents, you have modules within a patent. So therefore you can improve the patent through a foreign subsidiary and actually transfer the value of the entire patent to the foreign subsidiary as a result of licensing the initial modules, but then allowing the foreign subsidiary, or the foreign subsidiary itself, develops further and claims the R&D credits and all that sort of thing. And eventually you actually shift the value of the patent from one entity to another. That's quite normal. And when you think about licensing, you have the geographical area that determines how valuable that license is. You have the time period for which you're licensing, which again determines the value, and you have the exclusivity side of it as well. Non-exclusive is obviously far less value than an exclusive license. So there are all sorts of areas within the licensing arrangements. But one thing I wanted to ask either you, Mark, or Catherine, is how can small enterprises, if you like, decide between expensive patents, if you like, applications, or keeping the patentable idea secret? So, you know, the difference between trade secrets and patents. Would you like to answer that, Mark, first?
Sure. It depends upon the area of technology you're dealing with, because if you're in the electronics area, for example, everything moves very quickly, and by the time you patent things and you get your patent, the technology may well have moved on, and so that's an area where having a trade secret might be your better choice, because it you know, you're just never going to get the value of your patent. Conversely, if you're talking about the pharmaceutical area, if you happen to have a breakthrough drug, there's usually not much of a way around that, and that is something that's going to last for, you know, maybe 20 years. And so that is an area where you're going to say, well, I do want my a patent for that. So largely it depends upon where you see the market going and how quickly you see the technology changing.